Okay, wonderful. So hey everyone, hi. The topic of this talk is opportunities in multifamily as the country reopens. And we're very lucky to have our panelists here who will all be on with their both the scope of properties and their involvement. They can offer great view and perspective on what's going on as we sort of unfold. I think we're still, what is this, June 2021. We're still in the early phases of the emergence of our new post-COVID world. And it's very interesting to see how everything is shaping up. So we're very lucky to have panelists with such a large scope of expertise and properties. So I like to put things in macro perspective because it is the bigger trends. The bigger trends are what drive the details and the specifics that we see playing out in multifamily in our transactions in our lives. And we're living through, I believe, one of the transformational event of our lifetimes, right? The world shifts every 80 to 100 years. This is our event. And what COVID has done is it's accelerated us. It's kind of this grand trend accelerator. And it's done, I think, two fundamental things, the effects of which we're going to see playing out in all aspects of multifamily. One, it's accelerated us. It broke habits. It was a full stop event that thus accelerated us into what we can call like the post-internet world. We had thus far been living in habits, in epicenters and cities and infrastructure that were all 20th century constructs. The internet came at the end of that century and it was incorporated like a new toy, but our habits all remained, how we work, et cetera. Well, now that's been changed. We had a break in habits. A not insignificant percentage of people realize they can work from where they want to live. We're seeing this dissipation of polarities, a more multipolar world emerging, and new habits around work and life emerging. Also, we had an acceleration of what was already unsustainable monetary and fiscal policy. And that's one thing that I like to emphasize because I think that many behaviors, corporate, individual, et cetera, are driven by monetary and fiscal policy in ways that most people aren't even fully aware of. Like we've had these very, very low interest rates for long periods of time, starting with Greenspan and then on with Bernanke with quantitative easing. And that's all led to issues with fixed income, chase for yield, malappropriation of risk, all these things. And we're seeing that sort of chase for yield and flow of money now affect multifamily with cap rate compressions. We talk about all sorts of things like that. So we're in this shifting world, and I think that the dust has just begun to settle. All right, so I like to, is Cheryl here yet? I was gonna start
She's
with
not
her.
on, but you can introduce everyone else.
Okay, cool. Well, let's start. If everyone could just give themselves a brief intro. I see Gideon. Why don't we start with you? Hi.
Yeah, hey, good morning, Anna. Thanks for that opening. That was great. And good morning to everybody else. My name is Gideon Pfeffer, and I'm the managing partner of the GSH Group. We're headquartered in Michigan and focus on vintage, value add, workforce housing. Majority of our portfolio is in the Midwest, and beginning in through the Southeast as well. And we're an owner operator. We focus on properties that are well located, but maybe need a little TLC. We've got about 5,000 units today. We purchased about 6,000 over the last few years, and I'm very excited about this conversation.
Wonderful. Thank you so much. All right, Chris.
Morning, everyone. My name is Chris Loeffler. I'm the co-founder and CEO of Caliber with the Wealth Development Company. We focus on helping investors, either individuals or investment advisors, grow their wealth with real estate. And of course, in the world of multifamily in the last 13 years, we've done everything from buying distressed and non-performing notes, transformations of existing assets, and in the current moment in time, we're doing a lot of new development and new construction and selling into the cycle that we see all-time high prices. So seems like a great time to be in the world of multifamily investing. And then most recently, I think relevant to the conversation, we launched a couple of years ago a large opportunity zone fund. So we've been focused on doing some opportunity zone investing in the Southwest, as well as everything that comes with that. So great to be here.
Wonderful. Thank you all so much. Okay, so I guess we can. We're just waiting for Cheryl, but we can get started.
Yes? Yep, absolutely.
Okay, cool. Thank you. All right, so let's start with monetary and fiscal policy concerns, because I think that's such a baseline fundamental driver all of this. Chris, what are your thoughts on how concerned the industry should be about inflation, the future of inflation, how that's going to affect the industry moving out, and then also how that relates to the concept of a new normal with cap rates.
Right. So I think we've got two things, certain trends that are hiding other trends, if that makes any sense. You've got obviously a run up in prices in materials and labor costs. Some people think that's short term. Some people think it's a medium or long term problem. We can argue about that, but I think that obviously is driving up pricing and valuations. But behind that, and much more importantly, you've got the entire baby boomer generation looking to retire and try to find some way to generate income in retirement, which has brought, just like we saw in single family years ago, has brought Wall Street fully into the boat of multifamily investing. I think that every investment advisor understands, and every major shop in Wall Street understands, that if they want to find fixed income, they're not going to find it in bonds. They're going to find it in multifamily real estate. That's become the new favorite asset class. And so making a 3 or 4% return on that type of investment for them is great, because it's 3 times the amount that they can get for their client otherwise. For us in the world of being developers and doing multifamily deals, seeing these cap rates, we're just like, geez, when is this going to normalize? And I think the answer is it's already normalized. So, the new normal is lower cap rates, and you've got to find a way to compete in that environment and understand that the support for that is basically paying for our moms and dads to retire, for those of you who are, in my age group. So, at the end of the day, I think that as long as you understand that market dynamic, you can be successful as an investor. But, I don't think that's going to change.
No, I think you're absolutely right. And on the other end of that generational spectrum, while we have the boomers getting ready for retirement, we also have this ongoing delay in household formation, where the younger generation is in increasing, actually in record high numbers, living with their parents and delaying household formation.
Yeah, that's right. And even now, friends of mine in their mid 30s, early 40s are saying, they just built this like amazing apartment complex next to me, and I'm in a single family home, but this is so much better. There's actually a look at, hey, maybe I should go live in one of these lifestyle complexes, versus just going down the path of buying a single family home like, my parents did. So it's interesting. The dynamics are continue to push towards multifamily.
Yeah, I agree. And I think that's going to also be tied with this phenomena of people working in a way that's more geared around the internet. I think that makes it more likely that you feel that you can move around a bit because you're not tied to your place of work as much.
Right. Those common area amenities become much more interesting when you can just sit by the pool and work and all that kind of stuff.
Yeah, and the ability to move, to not be tied to a property that you own, especially if you're younger. So Cheryl, there you are. Welcome. Thank you for joining us. We missed your intro. If you could please give us a little bit of intro about yourself.
Sure. I hope that's not the new normal, Chris, or not, at least not entirely. My name is Cheryl Moorhead, and I run capital markets for Sunstone Properties. We're out of Southern California, and we are multifamily value add developers and acquirers and operators. We don't do an awful lot in Southern California, but most of our properties are in Texas and Florida. And we're doing a few other things in Chris's backyard in Phoenix, Georgia, the Carolinas, Tennessee. That's sort of our smile states. And just, I'm sorry I'm coming in late, but I think that, it is becoming difficult with cap rates where they are for us to acquire as we normally would. We're certainly looking all the time in the value add space, and that's sort of driven us to do a little bit of development on urban infill in our own backyard, but also we're doing some build for rent single family in Chris's backyard. So. But really hoping there's a little bit of a change so that we can go back to our primary business full time. So
okay, all right. We're thinking. Do you anticipate that we're going to see this continued growth in the tertiary cities as people perhaps as the country becomes more multipolar? Is that part of your thesis?
Yes, I do. I mean, I do think, some of the gateway cities will, get back some of their steam, but I think there's a huge affordability factor that is driving people. And also, if you look at the migration trends over, since post World War II, it's incredible. I mean, to see the movement to the smaller metros and secondary markets, and just the South, from the north to the South. It's gone from like 65% in the north to 65% in the South. So, and a lot of that's about affordability and more space. So I don't think that's going to change back.
No, I don't think so either. I think I've been reading that there's actually in any given price point and for the same given customer profile, that people are seeking out more space. That's also one of the shifts that's happening right now. That's perhaps tied to people spending more time at home, some hybrid work models. So I agree. I think that this need for more space isn't going away.
Yeah, it's a little anecdotal, but when we talk to people moving to Phoenix or Denver, some of the markets that we invest in, it's not like they were perfectly happy in San Francisco and COVID hit and they realized, gee, I want to get out of San Francisco. It's that they, for 20 years had been thinking about leaving San Francisco, and COVID hit and they said, oh, I'm getting out of San Francisco. This is sort of like a long-term trend for most of the people that I tend to talk to, that they wanted to go somewhere else and they've been finally released to do it, which to me would suggest that they're not going back next year because things are better. I think that they're perfectly going to be happy. I mean, I'm sure there's going to be some people who are going to get to Phoenix, Arizona and say, gee, it's kind of hot here. Maybe I should go back to San Francisco. But, that's probably not going to be the main trend.
No, not at all. There's also that pressure point of the widening wealth gap and affordability also, which is going to be an issue in some of the more expensive places that they've left from. So Gideon, you guys have, I think it is 5,000 units, right?
We do, yeah.
Correct, right. So give us some insight. What are you seeing as far as collections are going as this market as the world is opening back up?
Well, obviously we did see a couple point drop across the portfolio with collections through COVID, but it wasn't nearly as catastrophic as we feared in March of 2020. In fact, it wasn't catastrophic at all. I think we benefited from some of those, the secondary and tertiary markets that we were in. We saw, I think that everybody saw that the Midwest performed exceptionally well comparative to like the coasts, and even certain areas in the South and the Smile Belt as it relates to collections and occupancy, where as COVID is, when we see a light at the end of the tunnel, things are kind of been back to normal at this point, besides, working through some of those late or non-payers and wondering when we can actually evict them and turn those units. But ultimately, the pandemic didn't pose a significant problem for our portfolio. Our thesis of, B-class, workforce housing being relatively resilient in a recessionary period was proven. And proven really well, and we've been able to continue, not miss any distributions and continue to make our preferred payments to our investors. If anything, today we've got just an incredible amount of investor demand who want more, and we just have to be more and more prudent with the pricing, which has been mentioned. I wanted to make a comment on that. Our model has always been value add, and I used to worry about saying this, but because it would make me maybe not look smart or have people raise an eyebrow. But I've never been a cap rate buyer, because to me, being a cap rate buyer is buying into the previous owner's management philosophy and the current state of the property. Frankly, I buy in good we buy in good locations, and we buy based on a perception of being able to increase the value of the property through some sort of, value add, whether it be renovation with rent premiums or better management or whatnot. And it's become more competitive in today's environment, and cap rates are low. We have to cast a wider net, but we still are seeing opportunities that make sense.
Okay. What sort of opportunities are you seeing that make sense? Where do you see?
I just mean, like, you know, we're combing through so many deals a day, and a deal that doesn't make sense is, you know, the price is just too high that we can't. Everything has to go perfectly, and in order for us to achieve, you know, a return profile that our investors want over the long term, and we'd like to be a little bit more conservative than that. But there's still opportunities to buy at prices that maybe a lot higher than what we were used to, you know, 12, 24, 36 months ago. But we believe that there is still value to garner, and we can achieve the type of return profile that we need. So to me, that's an opportunity.
Gotcha. No, and I like what you made about the thesis of the Class BC housing. People always need some place to live, right? And a product that is necessary, such as a non-luxury place to live. Like, those people have to live somewhere, and that's a product type that's resilient in a downturn. I remember reading once that Buffett and Zell are the biggest investors in mobile home parks throughout the country, which their thesis represent the lowest rung of
yeah, you know,
to go.
So we create, you know, we try to find a property that's well located, that might have, not so much in the Midwest all the time, but, you know, newer product that has much higher price point. And so if we can go in, buy below replacement cost, increase the rents a bit, but still have them much lower than the newer products, but you know, create well amenitized communities. Often these communities that are older, built in the 60s or 70s, have larger acreage counts. They're more sprawling. There's more green space. They have larger square footages for the units, as you mentioned earlier, Anna, that people are looking for. And so we just need to enhance them from a, you know, interior and amenity perspective, and we can compete with the newer product, but at a lower price point. You know, our average rent for a 2-bedroom apartment community in the Midwest, actually not community, a 2-bedroom apartment unit in the Midwest is less than $1,000 a month.
Wow.
You know, that's true affordability, because when you think about the average median income of the country being well below $100,000, like, that's really what the majority of Americans need who are renters. They can't afford $1,500 or more a month.
No.
And it's hard to build into that. I mean,
it's like impossible to build into
new
it, right?
space. Yeah.
Yeah.
Right. I mean, yeah. What are your thoughts on material costs and all that affecting the availability of new construction at those price points? Okay.
Well, I mean, it was relatively impossible to build workforce housing before material shortages. So, you know, my theory is that it makes it even more difficult.
Well, I think it's kind of funny because I'm sure everyone on this call knows that those of us in real estate investment have always been a little bit technology resistant in terms of how we do things. But I mean, in the last month, I've spent time on mass timber, prefab construction. Right now we're building a 90-unit micro unit tower with, like, basically automated technology inside the unit so we can get it to an affordable price point. We're working on something called Herky-Wall technology, where you have interlocking panels and you fill it with concrete instead of timber. I mean, there's just like a gazillion things out there that people have tried to innovate over the last year to fix this problem. And I think the adoption of those will force the cities and the municipalities to start approving these new forms of building at a higher rate, right, which actually, you know, kind of counterintuitively could take us to the position where you look at the inflation charts and you see, like, oh, college tuition's here, and, you know, right next to medical's here, and then you can see TVs are down here. Like, at some point in time, you could actually see construction reverse course because of innovation, and some forms of construction could actually become much cheaper.
Well, that would be a great byproduct of all this, right? Change.
Yeah, as long as you're positioned for it. If you're not, then, you know, you're still trying to build traditional, or you're sort of like just not paying attention, I guess. It could hurt your business if you're in our sector. So
we've tried real hard on modular because it sounded like such a good idea, and I think everyone had that same idea. So that it turned out, for us at least, costing it out. I mean, it was more expensive than traditional, and the factories were so backed up that, you know, the prices went even higher. And I think it's become very popular with municipal, you know, participated deals, so the costs are way up. So that hadn't, but
it's funny
we
because
keep
you see
looking.
the big Katerra bankruptcy and others, trying to get this done right. I kind of look at that the same way as I looked at, eBay back when eBay was born. People got defrauded. You'd see all kinds of horrible headlines, and then all of a sudden it was like, if you want to buy or sell something, you just go to eBay. It just changes so quickly, because in the background where you're seeing exactly what you're saying, Cheryl, these costs are way up. I completely agree with you. And you look at it, you're like, why am I spending all this time on this? It still doesn't quite make sense. I'm also seeing old manufacturing facilities being bought up all over the country to build manufactured housing, basically. So if they're going to continue to invest in the infrastructure and the factories, at some point in time, we're going to have that break point where it's going to go, oh, wow, there's capacity and costs have come down, and it all just sort of falls into place. So I don't know when that's going to be.
Chris, I think you're right. But, for multifamily, I think that it might make sense for manufactured housing and single family today in some respects, but really on a micro level in certain areas of the United States. But, for opportunities in multifamily today, would you agree that it's probably far into the future?
It's going to be podium construction and you're going to go 10 stories and they're just going to crane in the units like little rectangles and build them. That's what they do for hotels. We're in the hotel business, and you're manufacturing these hotels. And right now, the only problem is you get it finally there, and then it's like, oh, they don't fit together. This is kind of a problem. So I think they'll solve that problem. And when they do, you can manufacture a multifamily unit, in a factory and crane it onto a podium. I think you're in pretty good shape. So that at some point in time, I think that will hit. But I agree with you. It's a challenge right now, Gideon.
All right, so open question, everyone. What are your thoughts on the growth, this rapid growth in single family built for rent, and the effects that's going to have on multifamily? Anyone?
I'd like Cheryl's opinion. She's
invested. Well, because our multifamily is workforce as well, and our tenant base is, I think, right about where Gideon was speaking. We're in the, I think, on average 80% AMI. That which we're building for new built to rent it really targets a different base, and it's these are the millennials and the baby boomers that are downsizing, that they can afford more than that. So it worries me that Lennar is out there. I mean, there's so much capital coming into that product right now that, I think it's right now, I think take advantage of it, because I think there's a market. And we found a way to scale, which was really a problem with, buying single houses here and there. But I think it's for those that have lots of student debt and don't have the down payment, with costs going up with single family houses. I think it's in California. I think in a year it's gone up 24%, something like that. So I think it's here to stay for a bit anyway. I just worry about all the capital that's coming in.
I think it's a perfect example of Wall Street coming in and massively affecting our business incredibly quickly, because, the second that Fannie Freddie approved a SFR for rent loan product, you saw the industry explode, even before they'd really figured out how to do it right. And they're still trying to figure it out, right? And some of these projects are wildly successful because they'll trade at really great cap rates, and they've got that permanent financing in place. So I think Cheryl's right. I think there's an opportunity right now. People should jump in if they can, but I think you got to be super aware of costs. And at some point in time, you might see in smaller markets that there is a ceiling to the absorption. That at some point, they're targeting a market that was underserved. We just don't know how big that market is.
That's true.
Yeah, correct. This is all part of that chase for yield a little bit too. Cheryl, I know you have a background in banking. I know we talked about your thoughts on like the Wall Streetification of the space, the bank coming in and changing the psychology.
Yeah, I know. I remember walking around in 2005 watching all of these, as a banker, watching all of these trades take place, the pooled loans, the 110% loan to value, and thinking, everyone thinks it goes up and somehow it disappears and it never comes back down again. And it's going to come back down, and it sure did in a tough way, but it was predictable. There's just really, as a banker back then, I'm always in the business of real estate. It was a fun business, and you got to underwrite things and really enjoy real estate. And it became financial engineering for Wall Street.
Yep.
Which
financial engineering is a slippery slope. You can go far on that road and have a disconnect from anything underlying and fundamental. It kind of feeds itself.
Yep. It's frightening. It ruined the business. Just like we said the other day, we don't want it to ruin ours, but I don't know how we keep them out.
I don't know either. The money needs to find a place to go. I think that's what it is.
Mm-hmm.
Exactly. Chris, you had some great insights on opportunity zones and the tax incentives there.
Yeah, well, I think just so that the audience can understand the scale, I think that we've done over $100 billion worth of projects that have been funded through opportunity zones. Now they're not fully built, and some of that money's still coming in, but that's over about a 2.5-year period of the history of this incentive. And if you compare that to the new markets tax credit, it's a 15-plus-year-old incentive that does about $7 billion a year in volume. So the volume is significantly higher. And during that 2.5-year period, we had COVID, and we had a very uncertain environment because the regulations or the rules around the regulation around opportunity zones hadn't been fully written until December of 2019. So to make a very long story short, I think that investors seeking a tax haven are going to be rushing towards opportunity zones over the next however many months or years. I think that, with the current administration threatening the 1031 exchange and the step up in basis, that's going to accelerate even further. And because of that, new development in opportunity zone census tracts, especially multifamily, becomes very attractive. So when you look at these census tracts, it's usually a mix of things that they need. It's not just one thing. You have to be very, what they call place-based. So what does this small census tract in Mesa, Arizona need? And then maybe that's 1,000 units of apartments, but it's also some retail, some office, and a hotel, or whatever the case may be. So I think that trend is going to push even harder into new development, especially in multifamily, because almost every census tract I looked at needs some multifamily. And, those investors have a different outlook. They're trying to exit at least in 10 years or more with a nice return. That really changes the decision-making matrix of what am I going to make over the next 3 to 5 years, right? So I think that it's going to be a big driver of our business.
One of the things about the opportunities, I followed it. We were thinking about certainly a fund, and some other day I'll tell you why we backed off from it. But it seemed like the regs were really focused for real estate, certainly, but also for businesses, for small businesses. And I don't think that we've been able to, or the government's been able to convey that opportunity, just for small businesses to start in those opportunity zones, because there's really some wonderful benefits. The net lease, that really gets the same benefits that a ownership does. It's fantastic, but it's hard to communicate all of that out. And of course, COVID hit, but.
Right.
Yeah, it's been strange too, because I've been on panel after panel and thing after thing on opportunity zones. And every time you get into this conversation, like you're saying, Cheryl, about, well, it's been mostly real estate investment and there's not been a lot of business creation. And at some point in time, you end up scratching your head and you go, well, we bought 160,000 square feet of a historic downtown, and we're putting businesses into business by giving them great TI packages and allowing them to start their business. So real estate and business are not disconnected. They're actually kind of interconnected. And it's the type of funding that those small businesses can't get access to. Their option is friends and family or the SBA. And if they don't want to go through either one of those two routes, coming into an opportunity zone where a company like ours is willing to invest the full amount for the TIs, plus maybe some operating capital, which is what we're doing, is a huge benefit. But to your point, the word is not quite out yet for those businesses.
And hard to get it out.
Yeah, correct. And oftentimes you'll actually see negative press about opportunity zones, that they're just tax loopholes for rich developers. There's an article here, like it was in the Herald some time ago about that, where the whole thing made it seem like some like weird tax break for whatever politicians you don't like friends. And how it was buying and pricing people out. Like,
you know, just as Donald Trump always seems to be, he was the double-edged sword for opportunity zones because he embraced the program, which definitely created a lot of visibility. But it wasn't really his program. It was a bipartisan bill from 50 senators and House members from each side of the aisle. And it was once he got out of office, we've seen that I think people are starting to take a harder look at the program to say, oh, actually, this thing's really working.
Well, the business case aspect isn't mentioned enough, I don't think, at all.
Yeah, because 95+% or more of the projects that have been built are perfectly in alignment with the goals of the program. Creating economic development in the community, creating a bigger tax base for local programs so you can pay for the services you're trying to pay for, creating more affordable housing. We just built 96 beds of behavioral health hospital out of this program. So there's all kinds of stuff like that that's actually happening. So the substance of the program is much better than the press. And, I don't know, maybe I'm an optimist, but at some point in time, I think the press will pick up on the substance and report on it.
Chris, is it an open-ended program at the moment?
Yeah.
Is there a finite amount of time that people can start in these?
Yeah, there's 3 benefits to the program. And as long as you invest by 12/31/2026, you can get the 3rd benefit, which is you hold for 10 years and you pay no tax on the upside. That benefit drives about 80% of the tax-oriented benefits and returns. The first 2 benefits are a deferral and a slight reduction in your tax basis, which theoretically could create a reduction in your tax. Those 2 benefits, if you say, hey, look, I'm going to get 8% IRR in this project, but I could get another 6% IRR boost because of the tax benefit, roughly 4 to 5% of the IRR boost comes from the 3rd benefit. So people can invest now and hold for 10 years and get that 3rd benefit, and they can invest up until 12/31/2026. And if our sources in the White House are right, we think that deadline extends in the future as well. So,
where did you build those 96 units you just mentioned?
We did that in Phoenix, Arizona, across from Banner University Medical Center. We bought an old assisted living facility that was boarded up, gutted it, put $11 million into it, and turned it into a state-of-the-art behavioral health hospital, which has been awesome. So we've got lots of those types of programs that are both. I mean, it was a great deal. We're into it for a 10.5 cap on cost, and we're going to do really well financially on the deal. But it also created 4,000 patient visits a year and 180 new jobs and all that kind of stuff.
Repurposed an existing structure, which is always a good thing.
Yeah. So, I mean, those are the actual projects that are getting done, and that's been true since the inception of the program. The press has chosen to focus mostly on the glass tower in Miami or something like that.
The funny thing with reporters, you always have to try to not trigger their partisan response, whatever it may be, and try to.
Sometimes that's impossible. I spent 2.5 hours with a New York Times reporter at SALT, going through every single component of the program, and they produced a 20-page article on opportunity zones with no mention at all. I followed up every 6 months for 2 years to say, hey, and every time I get the response, we know there's more to it. We're going to put on a follow-on story, and it's like.
I've spent hours conveying what I think are profound data-driven points to reporters, and they'll come back with something that I didn't even quite say, and I'm like, what? Got out of the hours I spent with you?
Yeah, at some point in time, I think we got to kind of skip over them. They're becoming less relevant as the internet continues to grow.
Well, you know what? And that's part of the multipolarity of our new world, right? Things are dissipating, and that's a super good thing. Now, you mentioned repurposing structures. So I did an interview recently, what was it, with the National Mortgages about, they want to know about how viable it would be to convert hotels in problem markets, hotels that rely upon business travel, for instance, which probably is not going to be coming back in significant percentages, right? So it's the hotels that are along ocean corridors that are going to get tourists, but hotels that rely upon conventions and business travel are hurting. So the question was, how viable is it for those types of properties to get converted into affordable or workforce housing or repurposed into multifamily? Anyone?
I think it's a very smart place to look. We've got 10 hotels in our portfolio. A friend of mine has a company called Vivo, and I think they've converted 13 so far since COVID hit.
For multifamily purpose?
Yeah, multifamily. Yeah. Having said that, we're working on 2 distressed hotel deals. I have another friend who owns 18 hotels and is sitting on $500 million in cash and can't find a single deal to buy. So there's not like this massive inventory of distressed hotels out there. Right. We think that there's more coming, but all of us are sort of like, you know, watching the market and still waiting to see something happen.
There's also at times it can be problematic, you know, unless you're in it for the long game in terms of the repurposing of the zoning and the different municipalities where these exist. You know, the idea is a great idea and makes a ton of sense. But then when, you know, we dug into it a bit as well. And I think that unfortunately the roadblock that we've seen in some of our locations with municipalities, you know, we might just miss the boat. You know, the delay is too long for us to really want to pay too much attention to it.
But they lose some tax revenue.
Yeah.
In converting it
the
to
taxes are set up
multifamily,
completely different. Exactly. It's not just like buy a hotel, convert it to an apartment building. You can't just go and do that necessarily.
Yeah. And really the type that works best for workforce would be extended stay hotels, and they have not had such a difficult time as, you know, as the luxury hotels and so forth. But even that,
I also question,
it's hard to convert. I mean, it's not inexpensive to convert.
Sure.
Mm-hmm. I think there's going to be plenty of people who are very successful in that strategy, and I don't necessarily mean to be a naysayer in general, but I mean, have you ever stayed in an extended stay hotel? Like, it's not like, it's loud, you know, you can hear people walk by outside, you can hear people in the room next to you, and I'm just not sure about the true long-term viability, you know, in terms of the asset, owning that asset long-term, as it being a great asset to, you know.
Yeah, if I was going to do a deep dive into a conversion play, I would be much more focused on suburban and urban office to convert to multi, because you've got typically higher ceilings, you've got the ability to just, you know, put in interior walls and repurpose a box, basically blow through the whole thing and repurpose it. You know,
it's like the adaptive reuse in urban areas.
Yeah, and I mean, it may not be workforce housing like in the Midwest, like you guys are dealing with Gideon or Cheryl, but it will be affordable for San Francisco. It'll be affordable for Scottsdale, you know, because it's you're taking a box that's already been built and you're just kind of blowing through it and hopefully buying it at a distressed price. So we haven't done any of those yet, so I'm talking completely outside of my skill set, but I would certainly look at it if somebody really worked hard on one and brought it to me.
Yeah. People were also talking about retail in that regard. And I haven't seen anyone really do it or try it yet, but there's going to be a lot of square footage at some point, and I'm not sure what we're going to do with it. But
one fun thing we're seeing with retail is people adding more what's it called, drive-through to go stuff, building stuff for drive-through to go, and taking away the inside square footage. That's one sort of adaptation that's happening now.
Yeah, we actually bought a old bank with a drive-through and converted it to a restaurant. And it was kind of a funky deal, but turned out to be really smart. We did it prior to COVID, and now it's like the best place to go get pickup.
We're a visionary. Look at that. I'm the vanguard of the new trend.
Pure luck.
It's pumping out works, right?
So, yeah, no, that's great.
Gideon, quick question on the just to circle back on collections. You mentioned that the collection situation wasn't dire. How much of that do you think was saved or is directly due to to sort of government intervention and the payouts that the federal government put out? Did that save the day?
In our portfolio, I don't want to say that it saved the day, but it definitely had a positive impact. You know, we definitely saw collections start waning a bit, you know, becoming a little bit more, actually I should say less, getting less collections over the course of like the third and fourth quarter of last year, when there was a stalemate in Washington and there wasn't another stimulus having been passed for quite a long time. And then they passed kind of around the beginning of the year. And I think that along with the fact that we had some hope along with certain businesses opening up in different areas of the country, and then the vaccine starting to roll out, we've seen a positive trend since that most recent stimulus. So it definitely had an impact. We held back our Q1 distribution, which would have been paid in April of 2020. We had the money. We had collected all rents through March, but we didn't know how bad things were going to get, so we wanted to have a little extra cash. We've since paid a majority of it all back, and haven't missed a distribution since then. But we did see collections dip a bit, a couple points in this property, a couple points in that property is probably about 2.5 percentage points across our entire portfolio.
Which is amazing, given, right, the disruption in the market and how high unemployment went and all of that. I find it remarkable. But that's what I'm asking, like, how much of it is government intervention? Like, what is it? Because if you look on paper and what happened to workforce and all that stuff, and then we don't see, I mean, most people are saying what you're saying, that there wasn't some colossal problem with collections. It's very interesting.
I think it goes back to affordability, like at least our model, again, this situation has made us look smart. We believed that providing affordably priced, clean, safe, well-located homes for people who want to rent was a good bet, and people care about the rent payment. I believe that the rent payment is kind of at the top of the monthly expenses in terms of what we should pay. We need a roof over our head, and there are few situations when people don't pay their rent, and so. I
agree, and you know what, renting. It's funny, I don't know if it's America, attaching the American dream to the idea of house ownership, right? I lived in Switzerland for 4 years before Miami, and the Swiss, which are remarkably stable people in society, they have an extremely high rate of renting. I believe it was in the Zurich market where I lived, it was something like 60 or 70% of the people rented, but they would rent for long periods of time and stay in the same place, but they rented it. It wasn't considered strange or less than.
Yeah, I think that's.
I think that we started seeing those trends over. Sorry, go ahead, Chris. I'll go after you.
No, go ahead. I was only going to say I think that it's just a shift. Maybe they rent and then they build their wealth through investing in other ways. It doesn't. You don't have to build your wealth by buying a house. You can. You can also invest in a private equity real estate fund and build your wealth and rent. It's not. It doesn't have to be. Just tied to that one home that you own. It's kind of like saying you're going to buy the building your business is in. Well, now you're concentrating your risk, like buy a different building that someone else's business is in. So that way, if your business fails, your building might be okay, So
there were trends before the pandemic, like young people choosing to get married later, young people choosing to live at home longer, to not buy houses, and probably most importantly, I think, from my perspective, for our industry, people not staying in one job for their life or two jobs for their life. There's a lot of changing, and so we saw the opportunity that renting becoming more prevalent because people don't want to necessarily create roots so quickly. They don't want to get stuck in a house. And I think that's going to continue to be true. And you mentioned it earlier, Anna, with larger square footages, now we're seeing with that great equalizer, like you mentioned in your opening with the pandemic, we're seeing people working from home more. So they're going to be working from home more. Maybe that'll keep them in one place. Maybe not. Maybe it'll give them the opportunity to be even more transient, right? Because they can work from any laptop anywhere in the country or in the world. And so I think that only benefits our industry. The less people buy houses, the more people need to rent.
Yeah, I think especially if you tie gig economy to workforce housing, right? So now I co-founded a company called Quick that does hospitality staffing in the Uber business model. So like you can work shifts as bartenders and waiters and stuff like that. And so you could conceivably have somebody who's living in a reasonably cost apartment in LA for the summer, move to New York for the high season, or whatever that is, to drive for Uber and work for Quick. Like you've got this ability to follow the trends of where where you're going to make the most money in the gig economy, and maybe that doesn't necessarily mean you want to own a home. Maybe that means you want to work seasonally. So really interesting stuff.
Well, I agree 1,000%. This concept of roots that I think Gideon just brought up, I think is great, because I think that perhaps how people perceive their own roots is shifting as you spend more of your sort of life in these virtual mediums. Perhaps that's how you think of your roots. It's how you connect to people on a larger the scale of the ether, right? It's not just physical anymore.
Yeah.
And that's not going away at all. That's increasing more and more for a certain percentage of the population. So people are not even going to feel the need to have physical roots that same way, because their lives are more over technology. And especially as somebody born in the year 2000, they never didn't have that. So that's not going anywhere.
It's funny.
I agree.
We started doing business with PNC, and years ago I did a lot with them, and I was surprised. This was pre-COVID, and I all of a sudden I discovered I'd be talking to a chief credit officer who is in Montana, and the head of real estate who was in some other place. I mean, the same management group was all over the country, and they were senior people, and they'd been doing that for a long time, and it worked very, very well. I mean, it's just like they were way ahead of the game. Yeah. And in banking, that's sort of unusual. But everyone was happy. They get together, living where they wanted to live, as opposed to Philadelphia.
Absolutely.
Exactly. I think the demand. Look, what have we done to younger generations? Look at student debt; it's off the charts. That also ties back to the low interest rate environment. Also, the issuance of all this nonsense debt. I think student debt is really criminal. But that's a separate conversation. I mean, you have kids who don't know anything signing off on these loans they can't default on, right? You can default on something as an adult with something you signed off on when you're 17. Come on. And then for what? Like
it's that same conversation around that inflation chart. You see what is off the charts in price growth, healthcare, student loans, blah blah blah. What is not? What has dropped precipitously? Cars, TVs, furniture. Yes. What do we subsidize in our country? All the stuff that's up. What do we not subsidize? All the stuff that's down.
It couldn't be more clear, actually.
I was looking at one of those charts and I was like, okay, so that has all the subsidies and that doesn't. What are we doing?
It couldn't be more clear, 1,000,000%.
Like even housing's on the chart up because we subsidize it.
Yeah. 1,000,000%. No, I know. And then it's
when you actually see Musk's financials overall, and you see how much of it is due to carbon credits, it's like,
oh yes, the whole business.
Are you kidding?
I
know. Great parts, but
you look at that stuff and you go,
doesn't really make any money.
No.
All the things we complain about with costs, we're subsidizing. Why? Maybe we should stop subsidizing. I don't know. Maybe that would help.
Yeah. Going back to how the press controls narratives, though, like you start saying that you don't want to subsidize education and you're an evil person, right? That's how the conversation is driven. But what are we subsidizing? Like, it's not even good education. And it's a massive debt for it. Like, what are you getting for this money?
Well, what's really suspect on that score is that, when I was in college and grad school, I remember, especially in grad school, that the professors had to publish in order to make ends meet. And now, they can work 2 days and make $400,000 a year. So, and they all have, a lot of administrative help that they didn't used to have. So those costs, a lot of the costs are within the people that are making the rules. And it's, I think, gotten out of hand. I mean, you can look at a payroll for a community college and it's just unbelievable.
It's gotten
but anyway, we're off.
I agree. So. Listen, but all this is tied up with these things tie in because you saddle people with all this debt when they're very young. And what does it do? It affects their life choices when they form families, when they purchase houses. All of this trickles through to everything that we're seeing.
Yeah, even to the extent that they view their communities and their country as a positive, right?
1,000%. Correct.
If they don't, then they're going to move, or they're going to try to go somewhere where they can be successful because people are people, and that's what we do. So, thinking about that and affordability, I think that's how it all ties together.
Correct. And then we add, an economic event that disproportionately affects people entering the workforce on top of that.
Yeah.
Mhm.
It's going to be an interesting next couple of years for sure. I hope that we can
I
turn it
agree,
around.
but I'm overall very optimistic. I really am. Like, I think that these periods of change, they foster innovation, right?
Yeah.
And I'm most optimistic about how much all of this has pushed us into building life around the internet in a way we hadn't before, because habits are sticky, right? So I'm actually quite optimistic about the general course of all of this reshaping. I think that the multipolarity is good.
Yeah, well, since
I did too.
Gregory decided to ask a question, I'll answer it. So
Yep.
maybe I'm not being clear. What I'm saying is, I think every kid should be able to go to college if they want to, and if they want to enter a contract, take on a bunch of debt to do it, then that's great. I think that I think it should cost less, because I think that we shouldn't be subsidizing the administration and the cost of the entire experience, so that when they enter into that contract, it's a contract for a price they can reasonably pay. And that when they exit and have a job, they're not spending the next 15 years of their lives paying off their student debt. I'm 100% supporter of education. We actually put a lot of money and time and effort into it. I just think that they should absolutely not have to pay that debt for the period of time that the current students have to pay it.
It also it used to be that school was priced so that kids could work summer jobs and earn enough money to pay most of it or towards it or whatever it is.
Yeah.
And now that's off by an order of magnitude. And I don't think the education got better by an order of magnitude.
Right. The pricing has changed in a short period of time is disproportionate to almost everything else in the country in terms of what things cost. So, I mean, I went to college 20 years ago, and what it cost then to what it costs now is almost twice as much, it was significant back then.
And it was expensive then, correct? That was already part of it.
Yeah.
Yeah.
You know, yeah. So we've got a couple of minutes left, right? So
Yep.
it's like I wanted to throw out there, like, there's a lot of like what ifs and a lot. I love this conversation, but fundamentally, I think that the same fundamentals that were true before the pandemic are true today, post-pandemic, if not even stronger, based on our conversations, right? You know, even though there's some questions around the 1031 exchange and will that continue or go away, we probably all have our own opinions. There are still significant tax benefits as an investor to buy real estate, right? You know, in terms of deductions and that perspective. So from what can you invest in multifamily and make a good return and have tax benefits at the same time? Yes, you still can, regardless of what may or may not happen in legislation this year or next. And on the other side, you know, where does the rent come from? The fundamentals are only continuing to get stronger. So like the opportunities from my perspective post-pandemic are very strong, stronger than they were before. And if you're looking in the right locations with the right operators, like my co-panelists, you know, you probably could do well.
Thank you. Agree 1,000%. Cheryl, closing words?
I mean, I'm excited about what's going on. I mean, it's a challenge. It's another challenge. I've been in and around the industry for 35 plus years, and have seen so many changes, and this is just one more. But I do think it always turns out to be an opportunity for a positive change in the end. And you just mentioned the internet, and I mean, there's no way, as tough as 2020 was, I got to meet so many more people around the globe than I ever could have. I mean, I missed being face to face with people, but I mean, it just expanded our world.
Very well put.
In terms of relationships.
That's exactly
it's really positive in that respect.
Agreed. Chris?
Thanks. Yeah, I agree with Cheryl. That's been one of the silver linings. The other one was spending, you know, an entire year with my 2-year-old, which was pretty awesome. And I think when it comes to this panel, what was the title? The title was Opportunities in Multifamily. So I guess I'll close with my thoughts on opportunities in multifamily. You know, I see it as opportunity zones. I think that flexible capital with the longer term outlook gives us the ability to win in this crazy pricing environment is a huge one. I think new and innovative building materials as a way to reduce costs and outperform the competitor is going to be really important. So I would be paying attention to that. And I think conversions, but I would focus on conversions in product types that are going to have longer term distress than hotels. I would definitely think more like office, more like large boxes that you can convert. That's where I'd be spending my time. I don't think there's going to be any distress in multifamily. I don't think that there's going to be some magical wand that will be waved that will allow us to start buying existing buildings at good prices again. I think you got to be innovative.
Agree. Just to circle back, just in your closing remarks, Cheryl, where do you see the opportunities, since that was the title of reform? What comes to your mind as the opportunities moving forward in multifamily?
For us right now, our immediate opportunities we see as the build for rent. We will always look for opportunities in value add because we believe strongly in workforce housing and the lack of competition for new supply. But the other thing that we're doing in California is we're looking for urban infill sites that are, they're in existing neighborhoods, they're properly zoned. There's been some new legislation in California to try to push to get through this housing shortage, and it's not working perfectly, but we're trying to find a way to build apartments. They're smaller, but they're, they can really, they're not exactly workforce, like we're buying and converting now, but they're still moderately priced. And we have 3 sites that we're working on now, just outside of LA. And so that's we're trying to address a real problem in this state.
Gotcha. And then Gideon, if you could just give us a few sentences of where you're seeing and seeking opportunities for a little flip.
Yeah, I mean, for the most part, we still focus on existing products. So, we're looking at, well-located existing inventory, apartment inventory that we believe that we can enhance that value over time. And that we'll understand where the replacement tenants are and that we're going to be able to keep it well occupied and achieve a satisfactory return. And despite the high prices, we'll continue to find those opportunities.
And can I just ask a question? Like, Gideon, what's your average hold time for property? I mean, long term?
So we're not structured like a closed-end fund where we're more opportunistic, and we look at all of our properties as long-term holds. We typically perform out 7 to 10 years, but if we could own them forever, we'd be happy.
Okay,
wonderful. Well, thank you, everyone. I mean, all markets are governed by supply and demand, and I think we all agree that demand is going to be strong in this space for many, many reasons that are being just accelerated by COVID. So I think it's a very bright future in general and for the space. All right, thank you, everyone. What a great discussion. Thank you.
Thank you, Anna. Great job.
Thank you. Nice job, Anna.
Awesome. Thank you guys for sharing your insight and expertise in this multifamily sector. This was an excellent discussion.